Ladies and gentlemen, we are back, Flamingo Property Investing, and I'm standing in the room with depreciation greatness here. I can actually see him. He's got his clipboard out and he's just walking around going $20 there, $30 there. Tuan from Duo Tax, the man. How are you, brother?
Very good, thank you, Jack.
Thanks for coming in.
Thanks for having us, yeah.
Mate, you are the man behind Duo Tax, one of the biggest in Australia. We'll talk through some of the numbers from how many depreciation schedules you guys do, because it's a fucking lot. And mate, we're going to do a one-on-one on depreciation because there's a lot to depreciation. I think a lot of people don't understand it. There's been legislation changes, in the recent sort of 10 years. And it's often a thing that is forgotten about for a lot of investors. I speak to a lot of investors and say, you're looking at your cash flow numbers pre-tax, but what does it look like post-tax when you claim your negative gearing and depreciation? And go, I didn't even think about that. Yeah. So mate, there's a lot to it. So let's kick off by going, in essence, depreciation. How would you describe it? And then we'll run through how it works.
Yeah, so essentially depreciation is just wear and tear on a building, and the plant and equipment inside it, and that's the way that the ATO sees it. Plant and equipment, specifically that, and also building.
Plant and equipment, itself. And when we're talking plant and equipment, folks, we're not talking like your little daffodils you got in a pot on the side. Plant and equipment, what is plant and equipment generally speaking?
Yeah, referred to as Division 40, if anyone wants to look that up. But essentially, plant and equipment, anything motorized in a property, or if you flip the place upside down, anything that falls, like a tall boy, floating furniture, freestanding furniture or equipment, that is all deemed as plant equipment, and that is depreciable in various effective lives. So if you've got something that's highly motorized, for example, an air conditioner, that has a much shorter effective life compared to carpet in the property. Carpet might have a 13-year effective life versus aircon only 7. So
what are the most common things in that plant and equipment category? So it sounds like air conditioning. What about things like dishwashers and stuff like that?
Correct. Anything, even if it's bolted in and motorized, it's still claimable as part of plant equipment.
Fans?
Yeah, ceiling fans. Carpets, timber flooring.
Right.
But things like tiling is not depreciable as plant equipment. Right. Because it's affixed to the building. That's referred to as building depreciation.
They say timber floors are not fixed to the building?
That's right. Floating timber floors. So,
right. Okay.
Yeah.
So that's plant and equipment. And essentially you can... I guess in layman's terms, when you put that stuff into a property, it's worth its maximum amount of money, right? Because it's brand new.
Correct.
Think about it like when you buy a brand new car, the day you buy it is the maximum it's worth.
That's right.
Unless you buy a special car like you like, right?
Plus labour.
That's right.
And you got to add labour on top. And that's also depreciable as that forms part of the cost base of that asset.
And then over time, it's worth less and less, right?
Correct.
Because it gets older.
Yep. And that decline in value is depreciable in those respective years, depending on what those effective lives are that's ATO provided. Right. The quantity surveyor us do is assess for the cost of that asset, especially when it's secondhand. With brand new items, of course, we know the cost of material from the Good Guys or Harvey Norman or whatever.
Could you get the receipts?
Yep. The cost of labour. If you've got the electrician or whatever to install it, you can deduct that as well. But of course, quantity surveyors are there to assess plant equipment when it's secondhand in nature, when it's applicable, but also the cost of the building asset value, which is what we work out on site.
So plant and equipment, and then what is the other side of depreciation?
So that's the building, and so building depreciation is referred to as Division 40. Division 43, and building depreciation has it is. There's a whole lot of tax terms around it, but Division 43 building depreciation has an effective life of 2.5% if it's a residential property. Or a commercial property, but once you go to like manufacturing, heavy industrial, those go to then 4%. So there's accelerated depreciation on those buildings because of the type of use that you have on that.
Right. Explain it to me in layman's terms. 2.5%. What does that mean?
So it means you get 40 years of depreciation on any building that's residential or basic commercial in Australia.
2.5% per annum.
Yep.
Is that right? Correct. So you can claim 2.5% of that building value per annum for the next 40 years.
That's right.
In short.
Yep.
Very good. There we go. So I break it down for layman's.
Yep.
And plant and equipment is essentially what was its new value plus labour, and then how long can you claim that for?
That's right. And essentially that is not claimable for 40 years, but it will be a much shorter effective life, which is what the ATO deems as essentially these assets differ in the sense that they will wear and tear much faster than the building.
Air conditioner might wear and tear faster than carpet, for example, or vice versa.
Exactly. And so what we're doing is the quantity surveyor assesses the cost base of not just the plant and equipment, but also the building. We're putting this together to form what is a tax depreciation schedule. So, working out what's the aircon, what's the furniture, what's the carpet worth, what's it depreciating at in each respective year, each financial year, and then assigning a financial year value for the building, combining those, and then what you get is a tax depreciation schedule, which essentially forecasts the amount of depreciation deductions you get each financial year for the next 40 years, potentially.
And essentially, every single year of those 40 years, I'm assuming the first year is likely to be the highest amount of depreciation you're going to get.
Just like a card deduction.
That's right. And then over time, the depreciation each year gets less and less and less because the value of all those things are worth less.
Correct.
Now, the way that it works in simple terms is, let's hypothetically say, over a 40-year period, you might be able to claim $500,000 worth of depreciation, let's hypothetically say. And it's front-loaded in the first, say, 10 years, and as we get to the back 30, it's lower. If you can claim $10,000 of depreciation in a financial year, essentially what happens is that $10,000 then gets offset against your taxable income. Correct? Yep. So you don't actually get the whole $10,000 back in your kitty. Yep. You get $10,000 off your taxable income, which essentially means if you pay $100,000 or $100,000 is your taxable income, you claim $10,000 against it, you'll only pay tax then on $90,000.
Correct.
Which means if you're probably on a 30% tax bracket, give or take, you probably get $3,000 off that 10 back.
That's right.
There we go. Should have been an accountant.
And then most of the time, the reason why people, as you mentioned it before, Jack, is that people often miss this. And the biggest reason why people miss the deduction of depreciation is that it's an on-paper loss.
Non-cash item, we call them.
Non-cash deduction, right? And everything we do, like strata fees, community levies, what have you, water rates.
We pay out of our pocket, right?
Correct, yeah. They cost you money. So they're essentially an out-of-pocket expense. Hence, you always think about it for the deduction. And it's always on your bank statement. Whereas a depreciation schedule isn't on your bank statement, and you need advice to get a deduction on the depreciation. And so because it's on a paper loss, it's only that you don't need to fork out a $10,000 expense on the building to get the $3,000 back. And that's the biggest clincher for people. And that's why a lot of people in Australia do miss out on this deduction.
Let's say they did miss. Like, we got thousands and thousands of people that listen to this podcast every single week. I would say a vast majority of them go, fuck, I've never heard of a depreciation schedule. I got to get in contact with Tuan.
I bet.
How do we go if you've owned a property for 5 or 10 years and they haven't claimed depreciation? Is there a way we can go back to year one and claim all that depreciation since we've owned the property? Yeah,
they do have abilities with the ATO to go back and claim.
Right.
So for any individual, without a doubt, you can go back and amend 2 years of tax returns.
Right.
So from the notice of assessment date that you receive that notice of assessment, you have 2 years to amend that tax return. So you can go back right now in 2024, you can go back to your 21 or 22 tax return and go, okay, I forgot to claim depreciation. I'd like to claim it for those years, 22, 23, and of course doing 24 as well. But if you do go further back, we have had customers before that go further back and they go, oh look, I've never been given this advice about depreciation. I've held this property for 30 years. They might go back and say, hey, look, I want to claim from 1995 or 2000, whatever it was, and then claim the depreciation. Now, when you do that, you do submit a form called an objection form with the ATO, and it's then at the discretion of the tax office to permit you to claim the depreciation well past the 2 years. Sometimes you can go back to 4 years for a complex tax returns, like a company structure or something like that. But if you do want to go further back, it's at the discretion of the ATO, and it's called an objection form. Right.
So essentially, you can get a guaranteed 2 years of depreciation back from previous 2 years financials.
Yep.
But if you've owned a property for 20 years, it's not a guarantee, but you can apply by the sounds of it to try and get that back.
Exactly.
So in short, it's something that you ideally want to do as soon as you purchase a property, right? It's like a checklist.
Yeah, most inquiries we get is like, oh, look, I've bought a property and I'm settling in June. Do I want to get a depreciation schedule for a month? It's like, well, you don't have to. You can always go back and amend it. But, when you go to do an amendment with a tax return, that also costs you money. So you might as well get it up front. And even for the month, you might get a $1,000 deduction. And a $1,000 deduction is still some cash in your pocket. And then next year, you're getting a full years of deduction anyway. So
when you get the depreciation schedule, is it for that financial year? So hypothetically speaking, if they got a depreciation schedule in October, does that mean they can only claim depreciation from October, or they can claim depreciation from
Yeah, so it's
July 1.
The report is always prorated
Right.
from the date that they settle on the property and first start renting it out. In your client's cases, they might be settling on the property today, need 3 months to renovate, so the rental start date might be 1st of January, something like that.
Right, and that's when it's from.
Yep.
Now let's talk about the legislation change. We had a quick chat about it before we kicked off the podcast. Back in 2017, there was some legislation changed, which affected depreciation, what you can claim on other people's renovations when you purchase a property.
Yeah, that's an interesting one because that was a bit of a shock to me.
Right.
And I remember, I remember some competitors said to me, "Oh, I'm not sure what you're going to do, Tuan, when all this comes through." And it was a bit of a scary time. But needless to say, is that people have adapted, and essentially that 2017 legislation was prior to that date. If you held a property and you were the 10th subsequent owner of that property, and that property was built in the 1950s, and there was, say, 100 square meters of carpet, you could still get a quantity surveyor in that property, a residential property, any type of property, and claim a residual amount of depreciation on that ratty piece of carpet.
Right.
And this is the problem that the ATO saw. It's like, well, now it's almost like double, triple, quadruple dipping on the deductions on this same piece of asset.
There was no length of time as such.
No, everybody could claim depreciation on any type of property Australia-wide. And so what the ATO said was effective from the 9th of May 2017, if you exchange on your property after that date, any second-hand plant and equipment that you buy, which means that if you exchange on a property that's second-hand, you no longer can claim the plant and equipment on that property. However, you are able to claim depreciation on the building. That means that the building, though, does have...
The 2.5% per annum.
Correct. That does have some rulings around that. Now, Division 43, building depreciation, has a cut-off date of the 17th September, 1987. So your building has to be...
before that, no good?
No good. After that, all good. And if you do a renovation after 1992, 27th of February 1992, you're also entitled to claim that if it's not completed by you also.
Right.
So you could buy that, renovation that might be 20 years old and it's still all good for you.
You can still claim the depreciation.
The
so essentially, it has to be a major renovation.
No, for that renovation rule, it doesn't have to be major. So it could just be one bathroom, and you could still claim. Say that it was built, for 20 grand 10 years ago, you could still claim the $7.5 grand for the next 30 years. That's completely okay.
Right.
The other rule we are talking about is once this 2017 legislation came in, and because you couldn't claim any plant and equipment anymore, they made an exception, which is called the Substantial Renovations Revision to the GST Act, which means that if you bought a property that's substantially renovated by someone else, the previous owner,
and substantial renovation means.
Yeah, like new liquor paint, bathroom, kitchen, new flooring, that would be substantial, or what is deemed as substantial. And it's at the discretion of the ATO, quantity surveyor, and your accountant to make a determination on what is substantial. There isn't a strict guideline as to what is required, but that means that essentially then you can claim all the depreciation, even if it's not completed by you. So you don't have to go to the retailer to go get all these receipts to claim that depreciation. So they do have that for residential. So essentially,
there's the misconception out there with people that they think that if they buy an established property, they potentially can't claim any depreciation, which is not necessarily true. If the property's been substantially renovated, you can still claim a portion of that renovation.
That's right. Substantially renovated, minor renovations after 1992. If the property's built after 1987, and if they've bought new equipment or they've done the build themselves, if it's brand new, they can
So essentially, if there's a property that was built in 1986 or before, there's no building depreciation you can claim on that.
Correct, because it's all second-hand plant equipment, and capital works has been exhausted because of that cut-off date.
Yeah. And so essentially, our clients who do the major renos or build the granny flats, for example. The awesome thing about that is not only are they getting the uplift in the value, the uplift in the yield, they're then able to claim the depreciation on that renovation as well, right?
Correct.
So hypothetically speaking, let's say we spend 300 grand on a reno for a client. What would depreciation look like on a renovation like that? And let's say the renovation is flooring, paint, blinds, kitchen, bathroom,
joinery,
all that shit. Yeah.
So you will get probably looking at around that 15 to 20k mark on the first years, which is a bundle of essentially. I would usually apportion about 10 to 20% on plant equipment. So you're going to get 30 to 60k on plant equipment, depending on how good the equipment is,
Yep.
brand, make, model, and whatnot. And then, of course, the balance of it
Bunnings
being,
stuff,
240 grand. Yeah, even Bunnings will cost you 300 grand these days. That's a cheap reno these days, right? Which is ridiculous. So the balance of 240,000, which is the 80%, which will be your building depreciation value.
Right.
So that's usually the ratio I use, 20 to 80. Somewhere around there.
So you got 240, which you do 2.5% per annum.
Correct.
And 60 grand you can depreciate
at various
much faster.
rates at much faster. So that's where you get. So 240, you're probably looking at, what's my quick math there?
2,500 on 2.5% on 240.
6 grand or so,
yeah, give or take.
Plus some plant and equipment, probably another 6 grand in the early years. But what you'll find, because in using the diminishing value method, plant and equipment will be really aggressive in depreciation. So you might get 6 to 9 grand worth of depreciation, which gives you 15,
yeah,
and that will diminish over time. So you get really aggressive, and essentially probably at year 10 to year 15, you'll see 6 grand depreciation right up until year 40. So
essentially the double depreciation you're getting on both parts is good for the start of the journey.
For sure.
Which is actually a good thing, to be honest, because if you're buying a property and you're doing a reno and you're claiming depreciation, that's generally when your debt level's at its peak as well, and
yep.
That extra cash flow will be handy, and then as you start to decrease your debt over time,
yep.
Not having that depreciation won't be as important, but you still claim that $6,000 a year.
Correct.
And the thing that also people need to be conscious of is if you are a high income earner, you're earning that, what is it now? I think 130 to 190, is it? Is that the new tax bracket? And then
38%, or was it 38%? And then
yeah,
you go to 47.
That's right, over 190 or 47 cents. So let's say you're paying somewhere between 30 and 47 cents in the dollar in tax.
Yep.
Depreciation is most valuable to those kinds of people,
yep.
because you're paying the highest tax bracket, which means when you claim depreciation back, if you claim $1 of depreciation back on 47 cents in the dollar, you're getting
effective.
47% of that back, right? Which a lot of people forget.
Mm-hmm.
Now, something about depreciation that not a lot of people know who know depreciation is that there is a portion of depreciation that you potentially will have to not pay back, but it will come off the cost base of the property when you sell. Which means you will pay more capital gains tax. Can you run us through the 101s of that and what that looks like?
Yeah, well, end of the day, I'm not an accountant, but I do understand it. Not trying to give advice here, but general information from my understanding is that when you do claim plant and equipment, there is some balancing adjustment that needs to be made when you sell that asset.
Yep.
With the capital works or building depreciation, whatever you do claim, I believe that it all has to get added back. So, for example, today, if you buy a property for $1 million and you claim $100,000 worth of building depreciation, that means your property is worth $900,000. So if you go and sell that property again in, say, 2 years' time and it's worth $1 million, you actually have made a gain of $100,000.
That's right. Even though you may not have actually made a gain of $100,000 because you've claimed it's just the building portion of the depreciation though, right? Not the plant and equipment.
Just the building.
Yeah. So the 2.5% you're talking about per annum is generally the amount that, sure, you can claim it back, but you have to be conscious that when you then sell the property, you're going to probably pay capital gains tax on a higher amount, like Tuan said. Make sure you speak to an accountant about that. But
that's why I believe that accountants don't really recommend this. There's getting a depreciation schedule unless the investor wishes to hold the property for longer than 12 months, because there is some CGT benefits from what I understand. Yeah.
So it's a common thing. I actually saw there was a TikTok video the other day, or an Instagram video the other day, where someone was walking on the street and they, asking questions to people, and they stopped this older lady and they asked her a question about depreciation. She goes, bloody didn't know that. I just sold a property and then all of a sudden I got this capital gains tax bill. And if you've claimed $100 or $200 or $300,000 of depreciation, depending on the value of the asset, obviously, depreciation on high dollar value assets is more.
Yeah.
You sell the property and you think, oh shit, I've made 500 grand as a capital gain. But you've claimed 200 of depreciation, so you're potentially paying capital gains tax on 700 grand, which is obviously a larger
that's right.
capital gain.
You can't win everywhere.
No, that's right. We try our very best to,
but what it does do, and that's why tax depreciation isn't some holy gift that the ATO's provided. It's what they call a cash flow tool. All it's doing is advancing the amount of cash that you can bring out of that property, so you can build cash flow to do whatever you need to do, whether it's pay down debt or go to the next property and buy more property. But it's that incentive there to give you that upfront cash to help you leverage.
Which is an important thing, right? The cash flow. I mean, you bought some property in your time. I'm sure you know, right?
Yeah.
Cash flow is what keeps you in the game. Growth is what gets you out of the game eventually.
That's it.
So What else do people need to know about with depreciation? Like depreciation schedules, what are they generally like? $500, $600, $700?
Correct. Yes, we charge $700 as retail. We've got special offers with Henderson Group, as you know, and of course our referral partners. But it's essentially the best thing to do is people don't know when the property's built. Yeah, it's always worth asking. It costs you nothing to ask. These days we've got the tech there that's available. It takes us a split second to find out when the property was built, if the property has any renovations, because there's like thousands of bloody real estate photos that have been submitted by real estate agents. So we can look at that, look at what renovations have occurred, and give you a guaranteed deduction estimate before you even pay any money. So that means you already guaranteed the results before
almost
you even commit.
No risk, right?
Correct.
And again, if you're going to hold a property for 5, 10, 15, 20 years and you can get an extra few $1,000s a year back in your back pocket,
better than
makes
the
a massive difference. And again, it's a non-cash item as well, which again we're reinforcing that it's not like you've paid the money out and then you claim a portion of it back. You're not paying this money out, so it essentially goes to your net bottom line. It's like, well, if we've spent 20 grand to hold this property, we've gotten 3 or 4 grand back from negative gearing. That's right. And then we get another 3 or 4 grand back. It all of a sudden makes your holding cost significantly more palatable.
And the cost of the report is, of course, tax deductible as well.
Of course, it's meant to be. It's the only way we. It's the only way we get through. Yep. Mate, you've been in the property game for a long time. You've obviously I don't know how many bloody depreciation. How many depreciation reports do you reckon you've done? 10 years have you been around for now?
Yeah, almost 10 years. Next year will be our 10th year, and we've probably done a bit over 100,000 reports since we've started. Probably half of that in the last couple of years. So
crazy, 100,000 reports. I'm assuming some of them maybe for the same properties.
Yeah, we have. We're starting to come through and start doing doubles for some properties, and that is starting to happen, which is something we didn't think was going to happen. But
crazy.
It was a
And from what you see, like if you put your investor hat on, you obviously see a lot of real estate. 10 years in the game, what do you see as being an investment that stands the test of time? Because a lot of people invest in property purely for depreciation as well, right? Which may or may not be the right thing to do. Yeah. What do you see as a really solid investment over the course of that 10 years? Because you've obviously gone through properties when people have bought them. I'm assuming it.
Yeah, well, where I see my experiences that I've seen property investors come through, they do. I think going to a commercial is probably one of the strong points of the ones that do really well in our space.
So starting in resi, building a bit of wealth, and then transitioning into
commercial. And there's quality commercial assets out there. I know it's always a little bit taboo when it's talking about commercial, because people think, vacant offices and this and that, but commercial is everything that residential isn't.
Yeah, that's right.
So, it's literally the market out there is huge, and picking the right properties, and there's some really high end, really quality buyers agents out there that pick great stock, and and personally myself, I do a lot of commercial investing.
Right. Really did you start in residential world?
I did start in residential, and the transition across to commercial has been, I think, very rewarding, probably especially prior to COVID. Yeah. Now it's probably a little bit harder with the type of properties that you're buying are limited, and the yield is not the same as what it used to be, especially in commercial.
What were you buying net yields at? Or commercial assets, generally speaking.
Yeah, we were probably I was getting 8% on some of the units I was buying, and we were using it for our own purposes, but once we started renting them out.
Commercial, like industrial units, you mean?
Yeah, industrial commercial units with sort of mezzanine type, real basic, shoebox type of properties, and they seem to do really well. The demand for that I think in Australia has always been really high. Yeah. And it still continues to be this day. There's a lot of people that still do it. It's a really quality asset.
The yields, obviously, because the growth of those assets has been so significant, right? So the rental income hasn't been able to keep up with the capital growth. Yeah. So those yields have compressed.
And the great thing about commercial is doesn't matter what type of commercial, all of it is exempt from any legislation change with depreciation, which means that plant equipment, even secondhand, if you're buying an old pub, all that ratty carpet and bars.
Still claim it, hey?
Everything is completely
had
claimable.
Tui's new spilt over it for the last 40 years, and you can still
good
claim
as new.
So that's a really interesting insight. I mean, the way that we build out our portfolio plans for clients is just like you said. We start in residential land. You can take advantage of leverage, use a lot of the bank's money and very little of your own, and then eventually, once you have equity and capital to be able to invest, you start to transition into commercial, because that's where the income generally comes from. Yeah. And if you buy the right assets and get in at the right time, you can also get substantial growth on those assets too, right?
And the trend is, to be honest, when I first started, buyer's agency wasn't such a, wasn't so prominent in the space, but now more so, I think there's a clear trend of buyers agents coming around and giving really good advice. And there's, I mean, not all of them, but of course, the ones that do, there is a pattern. And if people are listening to the right podcast and getting the right information, they will buy right, even if it's residential, commercial. And I always highly recommend it.
There he is, mate. We met. When did we first meet? When I first got into the industry, I remember you come into Trellease Associates.
Yeah, that's
office,
right. Yeah,
back in the day,
many years ago.
There we go.
And I probably not had.
Well, it's been 4 or 5 years ago.
5 years ago.
I reckon you've gotten younger since then too. Mate, awesome. Any closing remarks on depreciation?
What have I got to say about depreciation? Look, it's money on the table. Cost you nothing to find out. Highly recommend you at least ask the question. It's as simple as, I'm about to settle on a property. Here's an address. Can you have a look at it? And if it's no, it's no. And if it is, then great. You'll know exactly what you're entitled to.
Cash back in your pocket.
That's it.
That's it.
Better in yours than the ATO, I always say.
That's right. Exactly. Thank you, great man. That was awesome.
Thank you, Jack.
This is general advice and does not take into consideration your objectives, situation, or needs. You should consider if this advice is suitable to you or your circumstances, and please read any applicable PDS beforehand. This is a Henderson podcast production.